After 5 weeks of gains on the S&P 500, pulling back just a touch. Live from New York City this morning. Good morning, good morning. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Ferro.
Live from New York, coming up, equity markets on a 5-week winning streak as bond markets steamroll. Chair Powell's caution, rate cut bets push gold to an all-time high. We begin with the big issue, selective hearing.
We've been engaging in a lot of selective hearing.
Markets are hearing what they want to hear.
We see in the bond market, they don't really believe the Fed yet.
The market is misinterpreting some kind of enormous Fed pivot.
Markets have now priced in over 4 rate cuts next year.
This belief that the Fed is done and that rate cuts are around the corner.
Powell's message, I think, is pretty clear.
Powell has been very consistent in his remarks.
In line with things that he said previously.
He has said, let's just calm down.
He still has a strong bias to continue fighting inflation.
Chair Powell is really determined to keep inflation down.
They're looking for material economic slowing.
The idea that they're going to quickly cut is something they want to push back against.
The market is desperate to get a directional view.
I think patience is the word.
This will go on for months in terms of when we really get that clear signal that the job is done.
Starting the conversation this week, PGIM's Greg Peters, Sonal Desai of Franklin Templeton. Sonal, first to you, has this bond market got selective hearing?
I'm just looking at the fact. I'll just say one thing. Powell put financial conditions on the table. We at this point have unwound 375 basis points of rate hikes. We're back to when the Fed was at 175, middle of 2022, in terms of where financial conditions are. So yeah, I think the bond market has got selective hearing. I think we are very much ahead of ourselves here.
Let's get into it, Greg. Just how much daylight is there between what the Fed is communicating and what this market is pricing? And is there anything specifically problematic about that?
Yeah, so I would say this is a continued theme, first and foremost, Jonathan. So, I mean, the markets have been fighting the Fed the entire time. The disconnect between what the Fed has been saying, putting in their dot plot, and being priced in the marketplace have been decidedly different. So this is not new. It's just now an extremist. So if you look at what's being priced in the market, it just is curious to me because to have so much in the way of rate cuts at this point with a soft landing, it is really quite curious to me. So I think the markets have really pushed the envelope here to such an extreme that it's making it really difficult to be successful from an investing standpoint. So I think directionally is okay. But just the move has been so powerful, so much that you're really pushing it to such an extreme level in my mind.
Greg, take the move of last week, more than 40 basis points lower on a 2-year yield. That's a monster move, encouraged maybe by the words of Governor Waller. But as we've indicated, ignoring everybody else, including some important words from Chairman Powell. Greg Peters, when you look at moves like that, would you go as far as saying that the Fed has lost control of the bond market?
No, I don't think it's lost control. I mean, arguably, it hasn't had control the entire time. But it just speaks to the positioning and the lean around the market wanting and this really desiring rate cuts the entire time, right? If you go back to March of this year, I mean, during the SVB crisis, there was 200 basis points almost instantaneously, right? So that really gave you a sense of the direction where the market wanted to go. This is just a continuation of that narrative. So the market's looking for rate cuts at any chance it can get. And so I think it really matters very little what the Fed says at this point. The market wants rate cuts, and that's what it's going to price in.
I'm pleased you brought up the failure of SVB and went back to March. Last week, so now that was the biggest weekly move lower on 2-year yields since March. Back in March, as Greg indicated, we were pricing the end of the rate hiking cycle, but we were doing so for all the wrong reasons. Things were breaking. There is a belief now we can price in the end of the hiking cycle and start pricing in cuts for all the right reasons. Labour market's going to be okay. Disinflation's going to continue. Is that too idealistic? Is that an aspiration? Too dreamy for you?
It's beyond perfection, right? in the sense that what we are pricing to get the type of rate cuts as quickly, as early, and as massive as the market's currently pricing, which is close to 125 basis points, starting with a better than even odds for March already, you would expect a significant slowdown, at which point risk assets make no sense at all, right? Because you need to have a significant slowdown. I repeat, it doesn't all hang together. It is beyond perfection at this point. So one of the two probably is wrong. And I tend to think, given the speed of the move that we've seen in the recent weeks, that's likely where the floor is. So continued volatility, i.e. we see rates rally, and then we're probably going to see them sell off again. So this is in the beginning of nice, long, steady rally down, I would say.
This is all ahead of payrolls Friday. The numbers so far are about 180,000, a median estimate in our survey. Mike McKee can go a little bit deeper. Morning, Mike.
Good morning, John. Well, we're going to have, as you guys have been talking about, basically the statistical equivalent of angels dancing on the head of a pin over the next week or so as all of this data comes in and the Fed is quiet. Market will interpret things the way they want to interpret things. You can see since Chris Waller a week ago said that the economy was slowing down, that's what we're getting from the ADP, from the Atlanta Fed's GDP now numbers. And you can see the number of rate cuts priced in has followed that lower. Do we continue to see that? Well, the interesting thing about this week's data is that despite Waller saying the economy is definitely slowing, a lot of the numbers we're going to get this week suggest that it's going the other way. We have higher ISM services forecast. We have lower jobless claims forecast on a continuing basis, and Friday higher jobs. Now, the Friday numbers, Jen, you were talking about going deeper. The thing you have to remember, we got 180 in the number there, but we lost 33,000 UAW workers the prior month. So as they come back on, that leaves us at about 150, which would be about the same as we had seen. Then inflation watch, earnings are supposed to go up on a week, month-over-month basis, and a year-over-year basis fall. So what do you make of that? And then the Friday data, the last thing we get is the University of Michigan inflation estimates, and those are forecast to go down. So we could see a little bit of a stronger economy this week and a little bit of a weaker inflation outlook, and therefore we leave ourselves about where we were by the time this week ends.
Mike McKee, thank you, sir. Packed with data. Light on Fed speak. No Fed speak at all. We are in the quiet period going into next week's decision. Let's cherry pick some quotes. Governor Waller, something's giving. It's the economy. That's Governor Waller. Fed Chair Jay Powell, we're well into restrictive territory. Greg Peters, what's the evidence for that?
Well, I mean, you are seeing a slowing, but you're seeing a slowing off of extremely high levels. So this is not surprising that you are seeing some slowing in the economy. But if you look at the jobs report coming out or slated to come out on Friday, it still suggests a pretty robust backdrop for labor. And to me, all roads point to labor. You need labor to continue from an economic strength standpoint, of course. But the flip side of that is that since we're such a service-led economy where inflation is really driven by services at this point, it's really hard to envision an environment where you get back to the 2% level when you have such a strong labor market, given that services is such a large portion of PCE. So to me, it's a double-edged sword here, Jonathan.
Citi say growth is tracking 2%. Payroll's coming in at 200K. That's their call for Friday. We just went through the estimates there, 180. And yet here we are, so now talking about being sufficiently restrictive and maybe a recession just around the corner. So now you say we still need to settle some massive questions. And I think one of them is where it's neutral. I'm not sure how we can say we are deep into restrictive territory without a decent understanding of where neutral is. So now, where is it?
So, you know, Jonathan, we've talked about this previously, and I tend to think that neutral is significantly higher than that 2.25, 2.5 the Fed has been talking about, because that implies a real rate of just 0.5%, assuming a 2% inflation level. And, you know, prior to the global financial crisis, over decades, that real rate was closer to 2%. Okay, so knock off 25 basis points. You still get to somewhere closer to 3.75% on neutral. Somewhere 3.75, 4% on neutral, upward sloping yield curve. Treasury shouldn't be where they are right now.
They've got an opportunity, Sonal, next week to do something about this in the dot plot, in their projections. Are you expecting that long dot to come up?
You know something? It's something I'm really curious about. I would expect that long dot to come up a little bit, but given the massive whiplash, every single thing that is spoken by the Fed gives the market, I think they would be smart to proceed with extreme caution in terms of what they're going to do with the dot plots next week.
Proceed carefully is the thing we've heard a million times. Greg, if you're given the opportunity to redo that dot plot, what does it look like?
Well, so I think that first and foremost, the dot plot is a cat herding exercise, right? So you have, all these different forecasts being thrown into the mix. So I think the efficacy of reading too much into that dot plot is overplayed. That being said, I do think neutral is a little higher here, but not as high as suggested. So I don't think you'll see much in the way of back-end rates moving higher in terms of the dot plot.
Well, this whole curve's moving higher this morning. Greg Peters, Sonal Desai, going to stick with us. Let's get into it. Talking of herding cats, look at bonds right now. Big move on Friday, pushing back against Chairman Powell's pushback. And then this morning, almost on nothing, up 10 basis points on a 2-year, 464. On a 10-year, up 7 to 427. Let's get into it and get you some movers going into the opening bell. Here's Abby.
Hey, John. Well, we do have U.S. futures to the downside right now. But first, let's look at two winners. And of course, Hawaiian Airlines through Hawaiian Holdings absolutely soaring, up 174%, the best day in at least a year, perhaps ever. We'll have more data on that on the open. This, of course, on Alaska Airlines bid $1 billion to buy Hawaiian Holdings, and it will unite two carriers that largely serve the Pacific region. Alaska Airlines, as we will look at on the opening, down, though, more than 10%, as is usually the case for acquirers. Marathon Digital Holdings up 12%. With Bitcoin above $41,000 for the first time in quite some time. But take a look at Meta Platforms weighing on the futures. The NASDAQ 100 futures down more than the others, having to do with Mark Zuckerberg selling $185 million worth of shares in November for the first time in 2 years after the roughly 170% surge. Big outperformance to tech, right now heading to its worst day perhaps since October 26th.
Abby, thank you. Meta making up almost 4% of the NASDAQ 100. Coming up on this program, Bitcoin rallying, gold touching a record high.
I've seen the gold move in different directions based on interest rates and based on currency moves. So it's very difficult to really ascertain, like, it's telling me something.
That conversation coming up next.
Gold is the worst thing I'm calling. To me, unless you hit somebody in the head with it, I don't know what you can do with it. I've seen the gold move in different directions based on interest rates and based on currency moves. So it's very difficult to really ascertain, like, it's telling me something.
Love Tony Dwyer, one of the best. Great to catch up with him a little bit earlier this morning as the everything rally moves beyond equities and bonds. Gold briefly shooting past the previous all-time high of 2,100. Bitcoin topping 42K, on track for its biggest annual gain since 2020. Both assets seeing sharp moves thanks to expectations the Fed is done and rate cuts could begin early next year. Let's get to the team coverage. Bloomberg's Simone Foxman and Isabel League joined us now. Morning, Simone.
Yeah, morning, John. But after gold hitting that record high against the U.S. dollar, it's actually retraced some of those gains down about 3% since then, and frankly lower than it started trading in Asia. Still up 12% this year. And so you have Tony Dwyer, you have the likes of John Stepek at Bloomberg questioning. Stepek says no one is entirely sure what's driving gold higher. Certainly part of the story is the end of the Fed's rate hiking cycle, with the market's price pricing in that rate cut right now and interest rate swaps in May, but maybe it's partly de-dollarization. Maybe it's demand from wealthy buyers in emerging markets. Interestingly, check out this GTV Go, because what's happened in gold spot has not necessarily happened in gold ETFs. In fact, gold ETFs have been sellers for most of the year, with holdings down by more than 1/5 since 2020. These buyers, these gold investors in ETFs, have driven previous rallies, and they are not there yet. We're still below inflation-adjusted highs in golds. Back in 1980, it hit 850, and that was equivalent to about $3,000 in today's dollars. But now we look at gold slightly lower than it began, and the likes of Barrick Gold, Newmont trading down in sympathy in the pre-market.
Simone, thank you. It's not just gold, of course. Isabel Lee, looking at the move in Bitcoin, having a look at 42K.
Hi, John. It did hit 42,000, which is the highest level since April 2022. But now it's pared back some of those gains, but still up. It's now at around 41,500. And of course, this enthusiasm is really fueled by the speculation that the U.S. SEC will approve a spot Bitcoin ETF by next year, and that includes from the likes of BlackRock, and of course that the Fed is done hiking interest rates. So the last time this level was seen was around April 2022, when we saw the collapse of the Terra USD stablecoin. And if this rally holds, this will be the biggest yearly gain for Bitcoin since 2020. So it's going to be 3 years since then. And while 42,000 is a big round number, crypto investors are happy, it's still a far cry from the nearly 69,000 all-time high that we've seen a few years back. We're still around 39% from there. And if you look at Bitcoin's weekly relative strength index, so that's a momentum gauge, Bitcoin is hovering around overbought levels. So we'll see if this rally holds. But across the board, it's a green on the screen for the crypto universe. We have Bitcoin up, Ether up, Dogecoin also up, and Bitcoin Cash. And of course, that's really banking on the fact that there's a cross-asset rally, gold is up, and even assets in money market funds are also up, John.
What a move in Bitcoin yet today. Simone, Isabel, thank you. Greg Peters, I want to come to you on the need for diversification, real, uncorrelated diversification, given that I think we've just had, according to Bank of America and Michael Hartnett, the best month for 60-40 going back to the early 1990s. And again, you see it on the screen this morning. Bonds down, yields up, stocks down too. Greg, if that's not going to break, where do you get that diversification from?
Well, so I think, in such a momentum-driven market, it's hard to get the diversification that the models predict over the short term. So, we take a long-term, medium-term perspective, and that's where the bond market really fits in. I think the real question on the table a few years ago, what was the value of bonds? What was the protective characteristic in a portfolio? So I think that's really changed on a go-forward basis. But, what happened last month, when everything rallied, starts to break down. But I think you need to take a longer term perspective. And I really think that 60-40 type of diversification with bonds really starts to assert itself.
Sunil, do you agree?
I completely agree, because I think bonds are that medium-term play, and the bottom line is excellent diversifiers. And beyond that, over the medium term, we're finally getting income again. It's been a long time, even with this massive rally that we've seen, which I don't think is going to stay. I do think we're going to continue to see real income coming from bonds, and that's important.
So now, what do you like in fixed income right now?
So, again, it's a difficult thing over the short term, but having said that, for some time now, we've been looking at this. I think probably the riskiest asset classes have rallied too much most recently. We do like staying shorter in duration, as we have mentioned previously. We went neutral. We've gone back to staying relatively short at this point. And I would say that going forward, we will probably be looking to stay higher in quality until we're more convinced that we are going to get some decent value out of risky assets. Right now, we think that the rally's overdone, especially in high yield.
Greg, are you on the same page?
Yes, I am. I'm very much on the same page. I think it's a high quality type of market. So you're not being rewarded to take a lot of credit risk in here. So we're definitely kind of higher quality, whether it's within the high yield market, the investment grade market we quite like, and portions of the structured products market. So it's not a time to take a lot of risk, Jonathan.
Greg, there used to be this story that credit leads. Do you still believe that credit leads?
Well, that was a story that the credit folks like to talk about. But I do think there is some some rationale behind that, but with the information transfer just happening so immediate these days, I think that lead time is decidedly shortened, and it's not a financing-led sell-off or rally. So I do think it's a little different this time, as companies have turned out their debt and they've locked in low cost of capital. So I don't think it's the same type of relationship that we've seen historically.
So now, just a final word from you on the same theme.
No, I would agree. This is in the current market that we have. It would be crazy to think that the type of rally we saw last week had anything to do with fundamentals. It has everything to do with the speed of information flow and people reacting immediately to the potential of what that information holds. So I think it's very sentiment driven. I don't think this has very much to do with real credit or any fundamentals for that matter.
I can sense the frustration from both of you. So no does I. Greg Peters, to the two of you, thank you. High yield spreads, 374. It's not just equities rallying, not just bonds that have been rallying, it's credit as well. Corporate debt rallying big time. I want to turn to the broader markets. It's an unwind to some of the moves we saw last week. So last week, fifth week of gains on the S&P 500. This morning, pulling back on the S&P by 0.75%. The support over the last month or so has come from the bond market. This morning in the bond market, unwinding some of that move as well. Big move on a 2-year last week of more than 41 basis points, 40 basis points plus lower. This morning up by almost 10, up 9 on the 2-year, so back to about 463 on a 10-year maturity. Further out along the curve on a 10-year, up about 7 basis points to, let's call it, 427. On a 30-year, up around about 4 to about 443. Coming up on this programme, the morning calls and later. Stifel's Barry Bannister seeing limited upside for stocks into next year. That conversation coming up next. Your opening bell is about 7 minutes away. Okay, 5 minutes out from the opening bell. Here's the state of play. 5 weeks of gains on the S&P 500. Longest weekly winning streak going back to June, equaling that run. This morning, pulling back just a touch on the S&P 500, down by around about 0.8%. On the Nasdaq 100, a bigger move lower. So if the bond market gave the equity market bulls some comfort over the last week, it's maybe spooking them a little bit more this morning. Your 2-year last week down by more than 41 basis points. This morning, we unwind some of that. The 2-year up by about 9 basis points to about 463. That's the price action cross asset going into the opening bell. Let's get you some movers this morning and some morning calls. JP Morgan upgrading Carvana to neutral, $40 price target, reflecting better productivity and improving operations. That stock is up by 3.75%. Your second call from Wells Fargo downgrading Lululemon to equal weight, removing the stock from its list of top picks due to its expensive valuation. That stock is negative 1.6. And finally, Mizuho upgrading GM to buy, $42 price target, expecting shares to rally after settling its dispute with UAW. That stock is positive 0.6%. Coming up on this programme, Stifel's Barry Bannister warning of a lost decade for US equities. That conversation is coming up next. Your opening bell with equities at session lows is just around the corner. Let's get your trading week started live from New York City this morning. Good morning. 20 seconds away from that opening bell. Equity futures negative 0.75%. What will it take to break that positive correlation between stocks and bonds again this morning? It's a reversal. Last week upside down, if you will. Yields up, stocks down. There's your opening bell. Switch on the board and get to the bond market. Yields look like this. Your 10-year up by 7 basis points. 426.64, up more at the front end. Last week, totally the opposite. Yields down aggressively. Stocks doing well going into the weekend. In the FX market, the euro 108.25, pulling back by 0.5%. The dollar showing a bit of strength again, reasserting itself against the euro that's starting to think about rate cuts. Earlier on this morning, we caught up with George Saravelos of Deutsche Bank saying he thinks this ECB goes first. He thinks they should cut, should, not will, should cut next week. 108.24 on the euro, and crude pulling back by 0.8%, 73.50 on WTI. 40 seconds into the session, we're down across the board here on the S&P. We're negative by 0.75%. On the Nasdaq, we're down by almost 1 full percentage point. One stock to watch at the open, Hawaiian Holdings. Alaska Air agreeing to buy the company in a deal worth $1.9 billion US. Abigail has more. Hey, Abby.
Hey, John. Well, with that stock up 184%, heading to its best day, not surprisingly, ever since going public back in 1995, investors are cheering the possibility that this deal will go through. Now, what is happening here is a roughly 100-year competition may be about to end because, of course, these two airlines largely serve the Pacific area. So Hawaiian Holdings for Hawaiian Air has agreed to be bought for $1.9 billion, as you mentioned, in cash and debt, would basically unite these carriers. They would retain their separate brands, but together, according to the airlines, have a larger reach. Now, it will solidify Alaska Airlines' position as the number 5 domestic carrier, but there could be potential antitrust action ahead. 80% of the domestic carrier airspace, of course, airline activity is owned by 4 airlines. Plus, recently, the Justice Department did file for the JetBlue and Spirit merger to not happen, and they succeeded in busting a partnership between JetBlue and American Airlines. Raymond James actually said that the combination could or would change the market's currently moderate concentration to highly concentrated. So on this, we do, of course, have Alaska Air down 18%. The acquirer, as you know, is usually down, but maybe it has something to do with these antitrust motions. Hawaiian, on the other hand, absolutely soaring. It had been into today down more than 53%. I think now it's down probably less than 20%, maybe even less than 10%, John.
It over until it's over. Abby, thank you. Watch this space on that story. A developing one for you. Want to get to Spotify. Shares of Spotify this morning on the move after announcing plans to reduce its workforce by 17%. Ed Ludlow has the story. Morning, Ed.
Yeah, good morning, John. That 8% move higher puts it on track for its biggest jump since late October, but the stock trading at its highest level since February of 2022. This is the third trim of workforce that Spotify will have done this year, but the deepest. 17% is about 1,500 staff. That takes the total for this year to around 2,000. What Daniel Ek, the CEO, said in his letter or statement is that they've considered doing sort of smaller reductions over a period of time, but decided that, quote, substantial action now was the right way to go. Remember, things aren't bad for Spotify necessarily. They're on track to add around 100 million users this year, which would make their best year for sort of subscriber growth. But profit is hard to come by. And when you take into account the one-time impairment charges tied to these layoffs, they're forecasting in the current fiscal fourth quarter an operating loss of 93 million euros to 108 million euros, reflecting charges of around 130 to 145 million euros. They were expecting operating income, positive income of 37 million euros before that cut was announced. So you know the story. They spent a lot on podcasts, billions of dollars, then they pulled back. I guess it's tightening the belt when times are good.
Ed, I said it this morning, cutting costs costs money. You're seeing that with Spotify this morning. Ed, I want to talk about Facebook. I want to talk about Meta. Zuckerberg selling stock. First time I think in about 2 years. What's the takeaway?
Yes, it is the first time that kind of Zuckerberg Inc. has sold Meta shares since November of 2021, though I would kind of say that this is a story about philanthropy and charitable giving. So in total, it's 682,000 shares worth around $185 million, but it's through charitable and political entities rather than him selling himself. The timing's interesting, though, right? Look at the year-to-date gain in Meta stock, more than 170%, and then remember how bad things were in 2022. Zuckerberg didn't sell any stock, even if it was would be for political or philanthropic purposes that year, because financials were very poor, investors were talking with their feet in terms of their response to his spend on the metaverse. The situation's improved, but again, I would just underscore, he has sold blocks of shares in the past. Remember that he and his wife, Priscilla Chan, have committed to give 99% of their wealth in their lifetimes for charitable causes, and that's kind of the rationale here, it seems.
Year-to-date move up by a phenomenal 162%. Ed Ludlow, thank you. Nothing to see here, maybe. Listening to Ed there. The stock is lower by almost 3% this morning. I want to take a look at Uber getting a boost as the company prepares to join the S&P 500. Isabel Lee on top of this one. Hey, Isabel.
Hey, John, it's not just Uber. We also have Jabil and Builders FirstSource joining the benchmark gauge. Uber and Builders FirstSource are rising, but Jabil is kind of trading lower. I think it's probably because last week Jabil reported that it cut its first quarter revenue forecast, saying it experienced a softening in demand. But overall, inclusion in the S&P 500 is a positive for stocks because a spot in the benchmark index boosts the trading company's liquidity and it boosts their investor profile. So both factors usually prop share prices higher. And the three will replace Sealed Air, Alaska Air, and SolarEdge Technologies upon market open on December 18. I want to hone in on Uber, though. So the stock has rallied year-to-date 132%. Bloomberg Intelligence said that Uber's inclusion in the S&P is a stamp that it is the market leader. And for a few months now, investors have been speculating that Uber will be included, and now they finally are. The company has also been on a good run. It showed its second straight profitable quarter, and many expect Uber's business to continue to expand, John.
Up nicely this morning. Isabel, thank you. The stock is higher by a little more than 4%. Check out Virgin Galactic. The founder, Richard Branson, telling the FT that he doesn't plan further investment into the company. Let's get to Simone on this one. Hey, Simone.
Yeah, John, this is sending shares down the most since June. Richard Branson telling the FT that we don't have the deepest pockets since COVID. The Virgin Galactic has about $1 billion or nearly, and therefore it should have sufficient funds to do the job on its own. But this is seen as pretty bad news, especially considering that last month the company worked to save about $25 million by cutting 18% of its workforce, discontinuing commercial flights for 18 months, and then also all of this trying to funnel money into its new Delta space plane. Last week, Morgan Stanley was talking about that news. They downgraded their price target to $1.75. Just a complete lack of catalysts that was their rationale behind that. Wall Street believes the company will have to ask for more funding by 2025. Branson says through 2026, it should be pretty well funded. He says he's still loving the company. It's really proved itself and its technology, and he remains one of the largest shareholders. But considering the collapse of Virgin Orbit earlier this year, that's the rocket startup, I think there's raising a lot of concerns in the market. We're looking at shares now down over close to 13.5% and down over 40% this year.
Brutal. $2 stock, $2 name. Simone, thanks for that. Thanks for the update. About 8 minutes into the session, here are the scores right now on the S&P 500. 45.66 on the S&P, up by 0.6% on the session. On the NASDAQ, up by around about 0.9%, down by around about 0.9% on the NASDAQ 100. A negative day here largely across the board, with the exception of the small caps. The Russell there just about positive by 0.2%. It is outlook season on Wall Street. You're familiar with that now. It's crystal ball type stuff. It's time to look into the crystal ball of Stifel. Barry Bannister expecting limited upside for stocks right in this. We see the S&P 500 topping out at roughly 46.50 midway through next year as mega cap growth loses some ground to cyclical value as a result of economic growth, inflation and Federal Reserve tightness, all proving resilient. Barry, I'm pleased to say, joins us now for more. Barry, always great to touch base with you, sir. Great to catch up this morning. Thanks for being with us. Barry, let's talk about the recent rally first. What have you made of the last 4-5 weeks in this stock market?
Well, on Halloween, October 31st, we wrote a note saying the S&P would go to 44 and obviously overshot that, but we were positive going into year end. But what we're seeing in the market in the next 6 months is more of a rearranging of the deck chairs. As the economy, the growth proves persistent, the inflation proves sticky, we're actually saying that the cyclical value, the banks, cap goods, energy, financials, materials, transports, real estate, they would gain ground, and some of these mega cap tech would lose some ground on the price earnings multiple. And as a consequence, the market doesn't have a lot of upside.
Would you expect the bond market to reprice on that better data as well? And just to build on what you said about sectors, which sectors would tolerate that best?
That's just it. More of a positive economic growth, perhaps a higher PMI manufacturing. We're looking for 53 on that index. Pickup in industrial production, durable goods. Generally a strong economy. You know, it's not particularly robust in historical terms, but it's better than what was expected, not just here, but abroad, China and Europe. I go for the more deeper cyclicals. The cyclical growth names like the Apples and Nvidias of the world are pretty pricey. And I think what you do is see a rotation in the market. Not good for the cap-weighted index, but pretty good for investors who pick the right industries and stocks.
Barry, I wonder where that would leave the banks, which seem to be rallying on lower yields as much as they sold off on higher yields, which is like an upside-down world. Not the world we're told about, not the world you and I have been used to over the years. Barry, where would that leave bank stocks?
Well, some of the horror stories with real estate are probably overdone in terms of the bank portfolios. The banks are also extremely well reserved. They're practically regulated utilities now. And I would argue that there's an oversold condition in the banks as the economy holds on because of a foreseen view that the loan loss reserves will not have to go up. There may even be releases back into earnings. So I think the banks would benefit from this. Again, we're talking about a trade, a rotational trade in the market within the context of a market that doesn't really go up much.
Banks had a decent week last week off the back of that bond market move. Barry, let's wrap things up by looking back before we start looking forward. When you start to say things like the growth can remain resilient, inflation can remain sticky, and that means tech maybe struggles, equal weight S&P over market cap weighted S&P, I think that makes a lot of sense to people, just as scenario analysis. But Barry, when you look back on the year, where growth has been pretty decent, yields have been higher, and yet tech stocks have managed to tolerate all of that and a whole lot more. Barry, what's your understanding of what's happened in the last 12 months, which makes you think it might be different in the next 12?
Well, the one thing that we probably could have caught and understood better was that after a 10-year period of prosperity for the technology sector as a whole, remember Meta's year of efficiency, well, what were they doing the prior 10 years? So what those companies did was cut costs. They had built up a lot of fat, and just like a person, they were able to lose that 10 pounds and keep those margins up. That had a lot to do with the earnings resilience of tech. And then, of course, the recent view that the Fed has done has helped the price earnings multiples. But I wouldn't get carried away with that. This Fed is concerned. This Fed has higher inflation right now than it's comfortable with. And they're in no hurry to cut, despite what the bond market's perception was.
Do you think we've seen the end of that cost-cutting exercise in Silicon Valley? Spotify this morning, 17% of the staff is going, stocks up 11%. To your point, the discipline that came through from Meta, that stock is up by 163% year to date, and some pretty decent top-line growth in there as well, Barry. Are you saying we've seen the end of that effort?
Earnings are great, but to be honest with you, the stock market itself aligns very closely with the growth rate, the 10-year growth rate, compound annual growth rate of the price earnings multiple. It's really a macro question of what's your multiple outlook. And one of the biggest changes in the market, the single biggest change, I would say, and of course the thing that most tightened the Goldman Sachs Financial Conditions Index in the last 2 years, was the Fed normalized the 10-year real yield, called the TIPS. That went from a minus 1.3 to a plus 2.3 at one point. And as a consequence, you had negative convexity. You had a price earnings multiple compression of the market. I don't see the Fed wanting the TIPS yield to go down dramatically. I think they've normalized it because inflation at some level is back. And so a more normal TIPS yield will keep a lid on price earnings multiple growth and thus keep a lid on S&P returns.
Interesting. Barry, we've got to leave it there. Appreciate the outlook for 2024 from Barry Bannister there of Stifel, looking out to 2024 with limited upside on the market weight S&P 500. About 14 minutes into this session, these are the scores. We're negative 0.6% on the S&P. We're down about 1 full percentage point on the NASDAQ. If you go into the bond market, there is a Y out there in fixed income. Yields are up across the board here. I'm not sure why they're up, though. We're up by about 9 basis points after a big move last week lower. The 2-year back to 463, the 10-year getting back to about 427. Coming up on this program, it's Merger Monday.
For Alaska and Hawaiian specifically, it really will help them cross the bridge to the other side of the river, so to speak, where they'll be able to survive as a consumer brand.
A $1.9 billion deal in the airline space. That conversation up next.
For Alaska and Hawaiian specifically, it really will help them cross the bridge to the other side of the river, so to speak, where they'll be able to survive as a consumer brand. During the pandemic, we didn't have the consolidation we probably should have had. We had the government stepping in to save the airline industry, and unfortunately, they couldn't save everybody, so now you're getting that washout.
Seeing some consolidation now. Merger Monday living up to its name. Alaska Air announcing plans to purchase rival Hawaiian in a nearly $2 billion deal that could provide a valuable lifeline to the struggling Pacific airline. In the pharma space, Roche joining the obesity drugs gold rush, snatching up Carmot for $3.1 billion, threatening to push the Swiss company into competition with Novo Nordisk. Your team coverage starts right now. Sam Fazeli in London, George Ferguson in New Jersey. George, straight to you. The line that we got from Alaska today: we are pro-competitive, pro-consumers. Do you see good reason for this deal to close?
So look, from a regulatory standpoint, I don't see any reason why this deal wouldn't close. Hawaiian's a very small operation. For Alaska to put it into its fold, I think is going to be a big deal. From a business standpoint, I really don't see why this transaction should occur. It doesn't really change Alaska. I think, it adds a little bit of Asia to it. It adds Hawaii, which they already have some exposure, as inter-island, which they don't have exposure at now. It adds flights into Japan from Hawaii, into Australia, into other parts of Asia, but it's very small, wide-body, long-haul operations. But really, if they want to be a big airline, if they want to be a full-service global airline, there's large gaps, and so this doesn't really get them, to any, I think, different place besides a more complex operation. It does save Alaska because Alaska has a lot of debt to refinance. It would come at very high rates, high teens, and so to me, it looks a bit transactional, not so much transitional.
So there's one deal that may not take place as well that we need to talk about. George, what is going on with JetBlue and Spirit?
The trial's been going, right? And so the sense I get, and I'll tell you, our litigation analyst, Jen Ree's been following it very closely. And the sense I get from her is that the government really hasn't made a very good case. And so Jen and I think, are of two minds of this. I always said that deal would get done. She thought maybe it wouldn't, but she said now it doesn't look like the government's made a great case. And it looks like that transaction could get done.
Here's a deal that is getting done as well. Roche, Carmot, $3.1 billion. Sam Fazeli, let's talk about it. It seems to me that you're either in this effort, obesity drugs, or you're not. And if you're not, your stock is struggling. If you are, you're booming. Is that the case?
Well, I hope that's not really the case, because these pharma companies do a lot more than just obesity drugs. But from the outside, when you look at it, John, I think you might think that that's what every pharma company needs to do to get their share price running. And you look at it today, Roche's stock is up about $5 and a bit billion, and the value of the deal is about $3 billion. So something's working. Obviously, I'm connecting two things together where I think there's a lot more going on in the market than just this. But let's not forget, Roche has been around these drugs before. This is not the first time they're touching these GLP-1s.
We were talking about how transformational a deal might be. We were talking about the airlines. How transformational might this one be, Sam?
Yeah, a long, long way to go. We've only ever seen early data. The weight loss is supposed to be something that you need to maintain for 6 months, a year, 2 years, etc. We've talked about that. And also something that you need the longer term data to know about the side effect profile and whether the drug is actually better than anything else on the market, which is what the company is suggesting. So very early days. We've only ever seen really phase 1 data, so you can't really call it transformational.
Stock is up this morning by more than 2%. George, Sam, appreciate the update. It is well and truly Merger Monday. Let's get you some sector price action. 22 minutes into the session. Let's say good morning again to Abby. Morning, Abby.
Good morning, John. And we do have the S&P 500 down more than 0.5%. So not surprisingly, the sector composition is a little bit more negative than not. And what I would really like to highlight, take a look at communication services down 1.6%. But we also have tech down 1.6%. Microsoft, Nvidia, Apple, all lower. Now, speaking of communication services, on this news in part that Meta, Mark Zuckerberg is selling shares for the first time, or did sell shares for the first time in about 2 years. We have the communication services down 6 out of 7 days over that time period, down about 5%, basically the worst stretch since October. And take a look at that cliff dive on the day on that Mark Zuckerberg selling his Meta shares, some of his Meta shares news.
Amazing. Abby, thank you. 23 minutes into the session, negative here by 0.5% on the S&P 500. Coming up, a sneak peek at a calendar for the rest of this week. Your trading diary up next. 25 minutes, almost 26 minutes into the session. Pulling back just a touch. As we say here a lot, no drama so far this morning. Negative by about 0.6% on the S&P as yields climb across the curve, reversing some of Friday's move. That's the price action. Let's get to the trading diary. The calendar through the week looks like this. Tuesday, we get US PMIs and JOLTS data. Wednesday, US bank CEOs testifying before the Senate, plus the fourth GOP presidential debate. Thursday, another round of jobless claims. Friday, it is the payrolls report coming up on Friday. I've been through the estimates a few times. 180,000 is the median estimate in our survey so far. From New York City, that does it for me. Thank you very much for tuning in Bloomberg TV. Good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.